Stock market investors, what is going on? My name is Jason and welcome back to the channel. Today, I want to break down 3 ETFs you can put in your portfolio and add to for the rest of your life. I got 3 excellent ETFs, a couple of monthly dividends, and then my favorite overall broad spectrum ETF that's in the growth industry that's got a ton of the big names that consistently has great returns year after year. Let's get into the video. All right, stock market investors, before we get into the video, if you could do me a huge favor and hit that like button and subscribe to the channel, it would really mean a lot to me. Let's get into my first stock. One of my favorites, it's VOOG. It's the Vanguard S&P 500 Growth Index Fund. It's trading around $374 per share. Year to date, up around 2%. Considering, this year peak to trough, we were down at one point, down 21%. So it's made quite the recovery over the last few weeks. The big tariffs scared everyone out of the markets, and then the tariffs got paused, and now everyone piled back into the markets. That's kind of how it goes with these ETFs. But if you look over the last 5 years, up 111%. You got to love that, guys. You have to love that. So now, I want to show you how I break down these stocks, how I value them, and why I love this one so much. Okay, so this is the Growth Index Fund for the S&P 500, right? So the trailing 12-month PE ratio is coming around 31. It's a little rich right now, I'm not going to lie to you guys, but that's why you have to dollar cost average into these indexes, right? And then as prices go down, that's when you continue to add more and more aggressively, right? So if you take a look right here, you always got to look at the expense ratios. That is a really low one at 0.07%. That's a custodial fee. That's great. It's less than 0.1%. I absolutely love that. And then it does have a small dividend yield of 0.60%. You're not going to get rich off of that dividend, right? But it is something coming to you every single quarter, right? I love that. And I always like to take a look at the holdings, right? That's really important to know what the hell you're investing in, right? Here are the top 10 holdings, right? And because this is the Growth Index Fund, it's a lot more concentrated, than some of the other funds like VOO. So that means the upswings are going to be higher and the downswings are going to be higher. So if you want a little less volatility, check out VOO. That's another one of my favorite broad spectrum ETFs. I love that. Okay, so NVIDIA right now, it's a little overweight, coming in around 11% of all the assets in this fund. I like when most of these are under 10%, right? So if I'm the custodian of this ETF, I'm going to start trimming my NVIDIA position and start allocating those funds somewhere else. As you can see, Microsoft and Apple make up around 6%. Meta, Amazon, and Google, which is Alphabet, make up around 4%. Broadcom, Tesla, Alphabet, there's GOOGL and GOOG. It's just based on voting rights. That's the only real difference. So Google is actually coming in right around 7%, right? And then Eli Lilly comes in just a scotch under 3%. So you really want to know what you're holding, why you're holding it, right? As we can see, the year to date up around 3%. You extrapolate that over the year, we'll still probably come in around 10%, which is great return on your money, right? I do always take a look at what's going on in all of these different funds and compare and contrast them and figure out where the best returns are. Like I said before, the PE ratio is a little bit high. Now, we want to take a look at performance, right? This is broken down year to date, 3-month, 1 year, 3 year, 5 year, and these are based on a compound annual growth rate. So average over the last 5 years, you're going to get around 16% on your money. The 10-year coming in around 14%. So it's definitely outperforming its category, right? All these different broad spectrum ETFs, it's beating them. Not by a lot, but you're still beating them. And if you take a look over here, the annual total return history compared to the category, right? 2024 was a really good year, 2023, and then like I said before, when it's vicious, it gets beat up. But if you bought heavy in 2022 after this downturn, you made a shitload of cash. That's why you always have to consistently dollar cost average into these funds. Like I said, net assets under management around 15 billion. Year to date, 2.47%, and net yield about 0.5%. I love the holdings in this index fund. One of my favorite overall broad ETFs. You could buy this every single month, every 2 weeks for the rest of your life. And then say you put in $100 a month. That's awesome. And then every like 2.5 to 3%, the index sells off, I'm buying a little bit more. I'm buying $200 a month. And then if it goes down 5%, I'm buying $300 a month. And I'm going to keep going month after month. And if we're down 20%, I'm putting in $500 a month, $1,000 a month, because that's when you want to buy when these downturns happen. Next up on our list is JEPI. It's the JP Morgan Equity Premium Income ETF. This is a monthly dividend player, right? So over the last 5 years, not huge returns, 12.5%. But the key to this is getting monthly income. And then you can start that snowball effect. So every month you get your nest egg grows a little bit and a little bit and a little bit. And over 5, 10, 15, 20, 25 years, that snowball gets bigger and bigger and bigger. And that velocity of your returns continues to increase as time goes on. Okay, so the key to this is getting 7.79% every single year. And the PE ratio is a little more affordable at 24.84. So as this goes down, right, I'm going to show you guys how to actually calculate this dividend percentage, right? So right now, you're going to pay around $56 per share. Expense ratio, as you can see, it's a lot higher than VOOG at 0.35%. So you always have to take that into consideration. Like I said before, I always like to see what we're holding, right? Top 10 holdings make up around 16% of this ETF, which is great. Nothing is over 2%. It's a very diverse basket of stocks, right? You got MasterCard, Visa, Progressive, AbbVie, Microsoft, Amazon, all in this fund, right? So, and then over here, you can see the sector weighting. Technology makes up 20%, healthcare around 14%, industrials around 13%, financial services around 13% as well. Okay. I love this fund. It's one of my favorite funds. You're going to get around 8% on your money. Not a ton of volatility, right? So that is great for people that are a little later or they just want to be super conservative with their portfolio, right? Maybe you allocate 20%, 25% in stuff that's not super volatile. This way, if a downturn happens, you don't get wiped out, right? So, guys, we're on Yahoo Finance. You want to click on historical data. That's going to allow you to look at this fund over certain time frames, right? Okay, so after we select our time frame, we're going to go to dividend only, right? And then we're going to go to monthly, and we're going to see the monthly payouts for your dividends over this time frame, right? And as you can see, you know, the dividends vary, right? In 2020, they had to reduce the dividend a little bit because of all the craziness that happened during COVID. But if you take a look over, since say, let's go to 2023, right? We'll start paying around 57 cents, and then it varies from month to month, right? But consistently, you're going to get between 35 and 48 cents per share. May was a great paying month for this stock. So let's take an average of all this, right? So over the last year, let's say on average, we make 0.35. So 35 cents per share, right? So that's being ultra conservative, right? So 0.35, we're going to times that by 12 months, right? And we're going to get $4.20. Then we're going to divide that by the current stock price, 56.31. And then 7.5%, right? And that's being conservative. If you want to do a different calculation, say you average out 0.4, so 40 cents per share. So we do 0.4 times that by 12. And then we get $4.80. Then we're going to divide that by the current stock price, 56.31. You know, so on the more conservative side, we're getting around 7.5%. And if they could keep this dividend over 40 cents, we're going to get around 8.5% per year on our money. That's awesome. You know, that's better than any CD you're going to get. And the volatility is not a lot. And, you know, what I would do is, as this goes down as well, you dollar cost average into it, and you get a great dividend player, these are really great in your IRA because you don't have to pay taxes on your IRA dividends when you take them out in retirement. So in my wife's IRA, we are building a huge dividend portfolio that's going to pay us a shit ton of cash 20, 30 years down the road. All right, now I want to give you my third and final ETF that you could put in your portfolio, stash it forever, and keep buying and buying. And that's the Global X Super Dividend US ETF. Over the last 5 years, even with this current downturn, guys, we're still up around 20%. So that's great, especially when you consider the dividend that you're getting, another monthly dividend player. So this is coming in around 6%, right? But this is a very undervalued asset in my opinion, with this PE ratio coming in under 12. So I think the share appreciation can get back up to that $19, $20 range. So if you're buying here at $17.87, I think it's a great ETF to add to your portfolio. Let's take a look at all these different companies in the top 10 holdings, which make up 24% of the total assets. We got B&G, Philip Morris, Altria, Universal Corporation, Omega Healthcare, Verizon, and then it's big in real estate, energy, and utilities, right? If we go back, you always want to check the expense ratio coming in at 0.45%. So this one is a little bit higher than some of the other ones, right? So you got to take that into consideration as well. But I do think if we look historically, over this stock price was up to, in the 19s not too long ago. So I think we're getting a very good value. Again, if we want to calculate the dividends, we're going to go up to historical data, right? We're going to go get in that range of 5 years, which I absolutely love. And then we're going to go to dividend only and then click on monthly, right? So they're paying around 11 cents. And the thing I like about this, it's been very, very consistent over the last 5 years. They've been paying pretty much between 10 and 11 cents every single month for years, guys. Of course, every once in a while it dips when the market dips a little bit, but on average, you're probably going to get around 10 cents per share. So if we pull up our trusty calculator, we do 0.1 times 12, we're going to get $1.20. We divide that by the current stock price of 17.87, and we're going to come in closing in around 7%. So if we could buy this at $17, we're going to be getting, 7.5% on our money each and every year. And like I said before, this is a monthly dividend player. So every month there's going to be a little bit more in your ETF, right? So a little bit more money going into that pot each and every month. So every month you're going to make a little bit more money and a little bit more money and a little bit more money. And it just continues to grow month after month, year after year, and decade after decade. So that's it, guys. That's my 3 favorite ETFs that you could buy in your portfolio and keep forever. DIV. JEPI, J-E-P-I, or you could do JEPQ, which is a little more volatile, J-E-P-Q. I love that as well. And then VOOG. And if you want to be a little more conservative, go VOO. There it is, guys. Thank you so much. Don't forget to like and subscribe. Peace.